do me a favor and just tell other people that this webinar is happening. Jay is always very insightful when it comes to markets. A lot to talk about that he's going to go over as far as the macro front, as well as also obviously on the infrastructure capital side of things, their funds. For those that are here for the CE credits, I promise you I will email you. I promise you I will get your information. Just stick to the end of the presentation. I'll get it from you for the CFP board. If you have any questions, type it in the Q&A or in the chat. We'll do it toward the end and make this as interactive as possible. My name is Michael Guy. Thank you for attending this webinar sponsored by Infrastructure Capital. The man of the 45 minutes, rough hour, Mr. Jay Hatfield.
Great. And so this is always a good start because this is definitely not the view from our office in Midtown. So that's the reason. Hopefully you can go visit this office. I don't know where it is, but we're in Midtown Manhattan, but that's not our view. And just a quick overview of our firm. We have 3 fixed income strategies. BNDS is a high yield bond fund. PFFA is preferred stock fund. PFFR is a REIT preferred stock fund, index fund. PFFA is low leverage, about 20%. BNDS and PFFR are unlevered. And then we have 3 equity income strategies. AMZA is pipelines, tax advantaged, ICAP, large cap dividend stocks, right individual calls. With all 3 of these funds, we use our GARP methodology to come up with a relative valuation matrix. And that's what informs our purchases and our sales as well. And SCAP, we have profitable companies. We screen for profitable companies. Of course, we always do. But if you buy the IWM, you get a lot of unprofitable companies. And we do write a small amount of index calls. We write index calls with small caps because small caps tend to skyrocket. They can get acquired. And so it's better to not cap your upside, whereas large caps typically go up some, but they don't usually get acquired because they're just our average capitalization and ICAP's over 100 billion. So it's okay to give up some short-term upside. And then you can see all of our funds have substantial SEC yields. So this is the actual cash coming in. We do enhance these with option writing, not with PFFA, but with the equity income funds. We have a unique take on the economy, which has been quite accurate historically. And the reason for that is that we look at the monetary base as a leading indicator, which is the simplest way to measure the money supply. And the reasons that's critical is the Fed has caused 13 out of 14 post-World War II recessions. But the only exception to that was the pandemic. So that was caused not by the Fed, but the federal government shutting down the economy. So really, the Fed has caused every post-World War II recession. And they do that by restricting the money supply, raising rates, which in 12 out of 13 recessions caused a housing recession. The exception was a 2001 recession. That was a tech bust. So all recessions come from investment declines and typically housing investment declines. So you might say, well, we have had a housing investment decline. We have a slide on that later. So you might ask, well, why haven't we had a recession? And we'll get into that, but it's really the 4th bullet here, 5th bullet, I guess. And I did try to talk about this really quickly on TV a few minutes ago, but that if you look at a chart we have later, the housing sector used to be way more boom and so therefore way more bust. But post of great financial crisis, we haven't had those booms. So when it comes off the boom, there's less layoffs. The economy slows, but it doesn't plummet. And in this case, also, we have this tremendous, not just spending on tech, but also tech infrastructure. So data centers, but more importantly, electricity generation. So it's the tech side is holding up the real economy or old economy, really, construction and housing slowing. So you have that dichotomy. So that's why it's critical. The Fed does cut. Thankfully, there's still 4 cuts priced in over the next year, We think Powell really signaled he wasn't going to cut in December, unfortunately, but we're going to have a new Fed chair that's going to be installed, not as Fed chair, but probably on the Fed as early as March. So you're going to have not even just a shadow Fed chair, you're really going to have two. So we think it's going to be more controversial to not cut rates. But even more importantly, this is the critical new data. We're going to put a note out on this. If you looked at the CPI report on Friday, it was super bullish. And the reason for that is this stubborn and miscalculated owner's equivalent rent finally declined to 0.1%, so that annualized to 1.2 versus the year-over-year at 4 over 4. And so this is the core of our CPI, R, the fourth bullet versus U. So we use real-time rents, but finally U is going to gravitate towards R. So in other words, the lagging poorly calculated BLS measure is going to go to our measure. So we're forecasting PC core, even as reported by the BLS, has a terrible methodology, will decline to 2 by the end of next year. So no matter, even if there isn't a regime change, there will be, but even if there weren't, even this incompetent Fed would figure out they needed to cut because employment's weakening and inflation is declining, particularly if you ignore tariffs as you should. Then the other macro point that you won't hear anywhere else is actually we're bullish on the budget deficit declining. 2 reasons. First of all, the OBBA, don't listen to anything here on the news. It's mostly political talking points from both sides. So we're not political. We belong to the greed is good party. But there was a ton of reporting, unchallenged, that it was a budget buster and that it was a huge tax cut for the rich. But that's like reporting on the news 8 years ago. So that was true of the 2017 bill, but not true of the OBBA. The OBBA was mildly budget restrictive because there were cuts in IRA, the CHIPS Act, and the subsidies for renewable energy. And there was cutbacks in Medicaid eligibility, not Medicaid, but eligibility. So that offset the tax cuts to the middle class from that was structured as reductions in tipped wage taxes and overtime. So totally misreported. So that's a little bit positive for the budget, not that positive. But what's really, really positive, and the CBO does not include, is the $400 billion of tariffs. So we're forecasting the budget deficit drops from 1.8 trillion, which was better than the CBO forecast, because again, they ignore tariffs, to 1.45 trillion. That's only 4.5% of GDP. That's sustainable because GDP normally grows at 5%. So when you hear about this dire fiscal situation, that's a little bit of old news, not great fiscal situation, but it's sustainable because of the tariffs. And hopefully we slowly increase those tariffs and reduce the budget deficit. And so we are optimistic, though, that because the futures market is still pricing 4 cuts in, it might be delayed. That means the 10-year will stay around 4, 30-year mortgage around 6, and housing should at least stabilize or if not recover. So if you want to predict the economy, look at the Fed, money supply, and housing. If you do that, you always will be ahead of the curve. And if the Fed did that, then they would have started tightening about a year earlier, because when housing prices went up 20% year over year, like they did in the first quarter of 2021, they should have known that was going to translate into rent inflation because they're highly correlated. But they follow this delayed index. So it was delayed both on the way up and the way down. So if you just follow those indicators, you don't need to listen to us. You can create your own economic research, but it's extremely effective. I did my master's thesis at Wharton on it. It's very statistically critical. And Keynesianism does not work for predicting the economy. In terms of what's the implications of this, we're bullish on the stock market. We raised our target to 7,000. Looks like most of the risks are to the upside on that target. I will say that earnings season's about to end, or the bulk of it. So we might have a little pullback. So, market's a little weak today. So that's normal, but that doesn't mean that the target is 7,000. It's not relevant. And on the other hand, too, it does, if we're right about that 7,000 target, it means the market probably will stall out or pull back a little. But it's not necessarily time to get out, because we still think we're going to be 7,700 next year. And both of those targets are 23 times the following year's earnings. So it's very obvious that some people don't do this. So if you have a end of 25 target, you use 26 S&P earnings, and which is 305, and the 27 S&P earnings is 335. So we're not expecting an expansion in the multiple. We think 23 is sustainable. A critical point about that 23 times, you might say, well, the average is 18 over the last 30 years. But what that ignores is that corporate tax reduction it was a gigantic reduction, 35 to 21. That expanded in our models, expanded the sustainable multiple by 4 points. So that 18 became 22. So 23, at least when rates are low, is reasonable, and particularly when you're getting fast earnings growth from AI. So we think the targets are very achievable. Risk mostly the upside. We've been extraordinarily accurate in our targets, really since we ramped up our PR activities in 21. So I wouldn't ignore our targets. They worked perfectly, really, the last 2 years. And we do think that you'll get some rotation like you are today into large cap dividend, small cap stocks. And if you want to be in fixed income, high yield is going to do well. So PFFA, which is high yield preferreds, high yield bonds like BNDS. You don't want to be in investment grade like BND, whose ticker we arbitrage by adding an S to. That's a Vanguard fund, yields 4. That's likely to be very flattish over the next couple of years because they don't have spread. Spread tightens when the stock market's up. So be in higher risk stocks, financials, industrials, tech, and higher risk fixed income, high yield bonds, and preferreds. And then we talked about a lot of this. The easy way to predict the 10-year is, first of all, you have to get the terminal rate on the Fed funds rate. We're estimating 275, as is the futures market. That's the normal rate. That's 75 basis points over inflation. If you measure inflation properly, which we do on our website, actually PCE-R, so we correct the shelter component to market for real-time data. We're at 2. So the neutral rate on the Fed funds is 275. Normally, the 10-year trade's 100 over that. That's 375. So don't get confused. Don't focus too much on the budget deficit, although that is a bit of a tailwind in our models. And a lot of, super bearish commentary like, oh, it's unsustainable. Rates are going to go to infinity. It's not the key driver of rates. Key driver of rates is Fed funds, Fed policy. So we're likely to have a 375 10-year that supports 23 times. This point here, fourth point. So if you're 70% correlated if you want to predict interest rates to the terminal rate. So that's really all you need to know. And in fact, we're a little bit short-term bullish on the 10-year because it's actually gapped out to about 130 over the expected Fed funds rate. So it's a little bit high. It should be closer to 100. So you might see the 10-year, well, either the terminal Fed funds rate will come up or the 10-year will drop. And we, mentioned that we prefer to be further out on the risk curve. And there's a great chart. You might say, well, why did we have recession? The Fed has tightened rates 15 times since World War II. 13 times we had a recession. Why didn't we have recession this time? We talked about already. We do have a tech boom, but also see that these peaks in the housing sector used to be way higher. And keep in mind that this isn't adjusted for population. So we used to top out at well over 2 million almost 2.5, 2.3 million, like before the great financial crisis. And then when you have this precipitous drop, then you have tremendous layoffs. People who are laid off do not consume. So investment leads the recession, but then consumption drops. But in this case, we capped out in this cycle. First of all, we had really low home building for a long time. And so we have a shortage of homes. So that stabilized the market. And then we're dropping from a much lower level. So there's fewer layoffs. And then the AI boom also absorbed some labor. So that's really the explanation why we didn't have a recession. But it does require the Fed to stay on track. It doesn't have to be this Fed. It could be the next Fed with a new Fed chair on track for cutting that to keep the 10-year somewhere near 4 and the 30-year mortgage around 6 and have the housing market at least stabilize, if not grow. And we are bullish on the economy. We think we're going to have a 3% growth rate because we do think construction and housing will start to come out of recession, be growing year over year on investment. Plus, you'll have continued tech spending. So we're bullish on the economy, really focused on housing. That's one of the two key indicators, the Fed, money supply, which is what the Fed controls, and then rates, and then the housing sector. This is a fantastic chart. I get excited about charts, unlike most people. But you can see this graphically, and we made this actually readable, which was nice, that this is year over year, this last 12-month number here. And that you can see that the two old economy sectors, structures and residential, are in recession. But IP, which is obviously software and then equipment, a lot of that's tech equipment. So it's electrical equipment for tech. That's kept investment positive over the last year. They have to ignore inventories because they're moving all over the place because of tariffs. But that positive investment kept the economy growing, but slowly. And employment's slowing because these very employment intensive sectors like structures and residential are in recession, so there's less employment there. If you didn't believe me that investment drives cycles, here's every cycle since World War II. You can see that on average, there's no decline in consumption. There is some that occurs, like I said, after layoffs. But, like in 49, actually consumption went up, 23% decline in investment. So investment's only 20%. Everybody says, oh, consumption's 66%. So that's what's going to cause recessions. But consumers consume. They're like woodchucks who chuck wood. So low-income consumers have to consume to survive. High-income consumers want to spend because they have high income. So consumption is really stable, but investment's not. You can see overall, we had a very shallow recession in 20 because that was just a quick, pandemic recession. This is just same data, but you can see that preceding every recession, you have a dramatic drop in investment. Watch our CPI-R versus U, because R, so in other words, our real-time calculation leads CPI. So that's why we're bullish that even the reported number will go to 2, because it's finally being reflected that shelter costs, owner's equivalent rent in particular, are declining. So this Fed has no ability to forecast. We do. And we're forecasting goes to 2. So either this Fed or a new Fed with a new Fed chair will cut rates, which is super bullish for the market. This is just a graph that shows what we were asserting, which is the 10-year typically trades a little bit over 1%, 1.05 over the Fed funds rate. And when the yield curve is inverted, it'll trade over the terminal rate. So that's why 277 right now is the terminal rate, 105. It's like 187, the 10 years, a little bit above that right now. So possibly we'll get a little bit of rally in the 10-year. And just another graph that shows the essentially the same data. The 10 years of about 1% over the Fed funds rate. What's the money supply? If you did that, unlike the Fed, you would have assumed we'd have near hyperinflation. We didn't have that, but we had double-digit inflation. And in fact, the monetarism, we had the perfect experiment to test monetarism. It worked absolutely perfectly, 60%. So this net increase in the money supply is 60%. And nominal GDP grew at 38. And Milton Friedman's theorem that excessive monetary growth above nominal GDP produces inflation worked absolutely perfectly, 22%. So he would be dancing in the streets right now because we kind of had this, unfortunately, a perfect experiment where we massively jacked up the money supply. The quantity theory of money worked perfectly. And Keynesianism completely blew up. The Keynesians came up with this transitory theory of inflation, was totally wrong. And then just some details, more almost disclosure about our funds. PFFA is our preferred stock fund, yields over 9 on SEC yield basis, which is the good way to evaluate, particularly fixed income. We are constantly managing 3 risks: interest rate risk, credit risk, and call risk. And we're taking advantage of the fact that this is an active fund. Index funds don't care whether securities trading above par. They just mechanically keep buying it because if they have inflows and they can't participate in new issues and they're rebalancing every month and they do the opposite of what they should do. They're cap weighted, so they buy more what's up, sell what's down. That's normally the exact wrong thing to do. We take advantage of that. So you can see that PFFA has a very strong track record versus the index and also just provides good stable income. Then these are almost more disclosure, BNDES, high yield bonds. We do look, just like we do with PFFA, for situations where the rating agencies are negative on a credit, but we think it's a great credit. So Plains All American's a good example. Rating agencies hate pipelines, particularly ones that pay dividends because they do a forecast. They don't delever. They ignore the fact you have great assets. The company has financial flexibility. They can reduce their dividend. It's great for the preferreds and the bonds. In this case, they're bonds. But so BNDES has a good track record as well since we launched it relative to the high yield index. MLPs have become a great asset class. They're challenged during the pandemic, obviously, but super stable, better capital structures than they used to have, great tax characteristics. With PFFA, MCA, you get a 1099, so no K1, so way cleaner tax reporting. And in this fund, there's likely tailwinds to our distribution because it does borrow money. Our cost of borrowing is dropping. ICAP's our large cap dividend fund. Has had attractive returns as well. We do write short-term covered calls on individual securities. We think a great strategy to add alpha. And that's reflected in the returns and also good income. SCAP, we mentioned, screening for profitable companies, writing small amount of index calls, not enough to cap the upside. And also, it's one of the few ways to generate income from small caps. And then we just have disclosures. So with that, Michael, I would open it up to see if there's any questions.
Yeah, and again, folks, for those that want to ask questions, you can put in the Q&A. I see a couple of people have asked here. Obtain a copy of the slide presentation. I'm going to try to make this an edited webinar on the Lead Lag Media YouTube channel. I'll put a blast out about that. Mike here asking about PFFA tax consequences.
Yeah, so the important thing about preferreds is the word preferred stock. So stocks can and do benefit from the same tax characteristics as common stock. So if you own any REITs, you get a 199A deduction. That's an equalization between pass-through and corporate taxation. Surprisingly, but fantastically, preferreds also get that deduction. They also, preferreds benefit if there's excess tax depreciation. And then also to the extent they're not cumulative, which isn't great from a credit perspective, but it's usually really high quality financials, you get QDI. So your effective tax rate, it changes every year, but it's probably going to be low 20s, assuming you have a 40% notional tax rate. So it is quite tax advantaged. And I would contrast that to BNDES, which you should assume you get a few preferreds in there, but assume basically that your taxable income is equal to your income. So your effective tax rate would be 40 on bonds. So it's more attractive to hold that in your IRA where you don't pay tax.
I don't think you and I have talked about this, Jay, but I'm curious to get your take on what's going on with regional banks the last several weeks. So there's been a little bit of a scare around private credit. Any thoughts there?
We think it's overdone. We would be nervous about credit if it was early 2022. So clearly you should be nervous going into a tightening cycle. There's a little bit of weakness in the auto sector. There's a big story in Wall Street Journal. There's definitely more repossessions happening. Below-income consumers pressured. You're seeing that from reports from Chipotle saying that. But that's a very, very small part of the credit capital market. So we're actually bullish on regional banks. We think when the Fed cuts, they'll have upward sloping yield curve, which is better for regional banks as opposed to money center banks are usually fully hedged. Regional banks usually aren't. And we don't think credit's going to be a problem. Although having said that, we think the real way to play, if you agree with us that we're not heading into a credit crisis, which, like I said, would be very unusual when we're in an easing cycle, we would recommend like our largest holding in ICAP, which is KKR, because there's a lot of fears around credit. They have relatively small private credit or asset-backed credit, about 10%. A lot of private equity will benefit from a booming stock market, very depressed stock price, great franchise, great brand, going to benefit from realizations if the stock market continues to be strong. So rather than going into, the blast zone, go one step away. Something is down. Even if there are credit problems, it's not their money because they're managing other people's money. They have a little bit invested. So we think that's an easy opportunity. Do you have to be patient? Every other day people sell them off because of these credit fears. But we think there's little evidence. If you really listen to what the bank said, not Jamie Dimon, who's always usually wrong, but the other bankers say everything's fine with credit. Few spot issues like there always is. So we're bullish on financials. We were bullish on Goldman and Morgan Stanley. Those are up like 100% since we started recommending them. So now you have to be patient, but we think KKR is in that same situation where you're not really taking that much risk because you're getting these great franchises, but they're out of favor and likely to, at least over the next year or two, become back in favor and trade up dramatically.
Let's talk about small caps for a second here. Obviously, SCAP has done quite well, and small caps are an area that I often focus on, at least on social media. But there seems to be somewhat of a stopping of momentum. Any thoughts on what's maybe happening, at least kind of short term here? And should we expect any kind of year end rally in small caps, or at least outperformance in small caps? I guess.
Well, so there's normally when the Fed cuts rates, so that's risk on. And small caps are clearly riskier than large caps and riskier than, tech stocks have, at least over the last 3 years, been very defensive, strangely. So they did start to rally, but the problem really, and it's not happening today, is that tech is taking the oxygen out of the room. So it's competing for capital with non-tech stocks, and small caps have only about 10%, particularly the value index exposure to tech, whereas the equal-weighted S&P is 17, and of course, the S&P is closer to 50 if you properly measure it. Because Amazon, is technically consumer cyclical, but it's really tech stock. So that's really what's happening is the oxygen's coming out of the room. But we think that tech is getting pretty fully valued. Our models show it's not in a bubble. but companies like Broadcom are close to our target. NVIDIA is getting closer to our target. And so like on days like today, it's not up, but earlier in the day it was, but the Russell 2000 is outperforming. So we think it's better to be not just all in tech. And we do think it's going to be in everything rally. So being in large cap dividend stocks like ICAP or SCAP, we think will pay off. You just have to be aware, like if there's some big super positive tech announcement that, it's going to underperform the market, but it's a good hedge like days like today where you got Facebook falling up and Microsoft weak, then you're going to outperform by having a broader based portfolio. And small caps are super cheap, have great growth opportunities, get acquired, usually do well, at least the ones we're in when they report earnings. So good long-term investment, but just be aware that, on certain days, if tech's booming, then the equal weighted S&P would be down, small caps will be down, and large cap dividend stocks will be down.
You often hear this term, markets are priced to perfection, right? So earnings come out and some of these companies, gap down. We saw that with Meta, obviously. Yesterday you mentioned Chipotle. That's obviously a weaker company dynamic, but how are earnings and more importantly, how's the reaction looking at you, the way things are playing?
It's not very surprising. The companies are beating consensus, but not necessarily beating the whisper number. And then, in the case of Facebook, it's really guidance. But to your point, these companies, we don't think they're, bubbles, but they're fully valued, so they can't really afford to disappoint. Whereas the rest of the market, like if you pick KKR, they're going to report next week. Maybe they'll sell off just because everybody hates the financials right now, particularly anything related to credit. But the expectations are really low. So even if they did slightly miss, they could very well trade up. So like Amazon's reporting tonight, maybe they miss, but the stock's only up 3%. The market's up, over 20. NASDAQ is least. So there you have a better risk reward. So it's pretty obvious. If you have big runs in stocks, then going into the print could be more risky than reward. And so that's one reason we think it does make sense to have a broader based portfolio where everything's not priced for perfection, and you have a better risk reward going into earnings.
And for the last question here on mine, again, folks, if you want to ask questions, click on that Q&A. I'm happy to bring it up. But let's talk about active versus passive for the rest of the year and then into next year. I saw some chart that showed the differential between high beta and low beta stocks on the large cap S&P side is like historic in terms of the last 6 month differential. Mm-hmm. What's the outlook on active versus passive going forward here?
Well, the first kind of obvious point is you absolutely need active with fixed income because you have to manage these somewhat obscure risks that don't exist with equities. So call risk, credit risk, interest rate risk. And so absolutely critical for fixed income, yes, BNDS and PFFA for our funds. Equities is more ambiguous because sometimes momentum is the most important factor. So in effect, index funds are momentum funds because they're cap weighted. So they buy more whatever's going up. So sometimes that works. If we do have more of a rotation, and we do position our funds for our view in the market. So ICAP's done really well this year, but partly because we positioned it in financials and a little bit of tech, not nearly, what the equal weighted S&P has, a little bit of tech, but more risk averse tech and industrials. So we think that active management, if it's properly implemented and then writing these short-term calls is a huge advantage, can be, but just be aware that it's more of a fair battle because of this momentum cap weighting factor working in some markets, like you mentioned this year, really being in the stocks that move the most. So they have higher market caps. So index funds have done fine this year for that reason.
Again, folks, if you're here for the C credits, I will email you by end of day, get your information to submit to the CFP board. As always, appreciate the support for those that are attending here. Jay, take it away with any final thoughts here and we'll wrap up.
No, I wouldn't be too concerned. We were predicting that the Fed doesn't cut in December, but just keep looking at the expected 1 year number, where the 10 year is, where the 30-year mortgage is. We think those will be relatively stable. And that we're really set up for a great market where you have at least gradually easing Fed, great tech dynamics, potential for rotation. So don't be scared out of the market. We might have a little pullback post earnings, which we're getting close to because tech earnings is really the bulk of earnings. But I wouldn't panic and sell everything. It's probably not going to be a tradable rally or tradable pullback. And so just stay invested. That's the best long-term strategy.
Okay, these are more about the CP, but there's one question from Sherry. Let's address this real quick. Any thoughts on the dollar here?
We have a unique view on the dollar. There was kind of a notion that the U.S. was going to hell in a handbasket and the dollar was super weak and we're losing reserve currency status. And we view it completely differently. If you look at the 25-year average, the dollar index is about 95. Over the last 10 years, it's right where we are now, around 98. Really what happened is people got super bowled up about the dollar when it became clear that Trump was going to become president. And we think that was kind of irrational. Like there's a notion who's going to break the budget, rates are going to go to infinity, and the dollar would be ultra strong. So it's kind of the opposite where tariffs are reducing the budget deficit, the Fed's cutting. But so we think the dollar is going to stabilize here where it's always been or where it's historically been. The U.S. is not going to lose its reserve currency status. In fact, it's stronger than it has been because this revenue from tariffs is going to fix at least the worst of our budget problems. So we're not bullish on the dollar, but kind of neutral on the dollar, which would be fine for investing in other asset classes. It means gold maybe will lose a little momentum because a weak dollar is good for gold.
And stay paying attention to Jay Hatfield, Infrastructure Capital. Thanks everybody for attending, and we'll see you on the next webinar. Thank you, Jay. Appreciate it.